All right. Today is Thursday, the 11th of January. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Boy, just when I wanted to do an easy show, just a friendly discussion, we shoot the shit, have a few laughs together, and cover the market and move on. Well, things keep developing here in a very dangerous way. I don't know if you recall, a couple of days ago in the coverage of the options market, we spotted a trade for the USO, which is the US Oil Fund, a bullish trade for oil prices to go higher. Let's hear what I said back then and then come back. Now, the position of the State Department is we don't want a war. We can't afford a war. We don't want to commit to a war. War is not popular at all. But this blockage in the Red Sea is important. It's going to cause inflation. That comes with a political risk. Even though it's not an immediate economic impact to us, but you've seen that container shipping rates went higher regardless, whether you're passing through the Red Sea or not. The talk right now is maybe we do somewhat of a limited military action in Yemen. I don't believe in limited, though. I believe that if you do limited and you try to be cute, you're going to run into a full-scale war. And here it is. Today, before we even got anything, the Wall Street Journal came out and said the Middle East braces for U.S. strikes on Houthis in Yemen. So the maverick Wall Street intelligence sources are a little more reliable than the Wall Street Journal. My sources are 2 days ahead of the Wall Street Journal. But here it is, the breaking news.
All right, folks, we're going to get to all that ahead. But first up on Last Call right now, a tense situation overseas rapidly escalating. NBC News is reporting that U.S. and U.K. military forces have just launched strikes against Houthi targets inside Yemen. According to two U.S. officials, they targeted multiple locations with both fighter jets and Tomahawk missiles fired from naval ships offshore. The strikes come as the Yemen-backed fighters have ramped up their attacks on Western shipping. Oil prices so far not reacting significantly to the news. They are up just a touch, about 2%. But it's not just the situation with the Houthis that is raising tension. Futures, by the way, also muted a little bit so far. Today, Iran attacking and seizing an oil tanker named the St. Nicholas that was on its way from loading up with Iraqi oil bound for Turkey. U.S. Central Command today said the status of the ship's crew is unknown and that Iran is still holding 5 ships and 90 crew members from ships seized nearly a year ago.
And just when you thought that all of this effort in the Middle East by Blinken, who's, by the way, a disgrace, one of the worst Secretary of States ever, 2 wars now happening under his watch, the world is a mess, and he goes on a tour to de-escalate. Next thing you know, we're bombing Yemen. And now, of course, they want retaliation. The Biden administration says, oh, we're just going to do a surgical strike here as a deterrence, but we're not really interested in a full-scale war. And I'd say, how can you avoid that? You can't. You bomb them, they're going to respond. That's escalation. What are you going to do next? You're going to bomb more. Be more aggressive. You're going to kill more of their people. Now they want more revenge, and it keeps going. Next thing you know, you're in a full-scale war. And of course, it's not just going to be with Yemen. It's going to be a proxy war with Iran happening in Yemen. And by the way, anybody heard from the Secretary of Defense? Because while all of this going on, we don't even have a Secretary of Defense. The guy's disappeared, and now they say, oh, he's in the hospital. He's watching everything. He's in command from his bed. And folks, this is what we talked about from the get-go. The geopolitical risk is real. It's all fun and games, and it doesn't matter, and you can dismiss it, and the market will go higher anyways, until, of course, there is an inflationary impact, and we see commodities going higher. Just in case if you doubted the fact that the U.S. military is not here to protect the U.S. The military is not here to protect us. Otherwise, they would have been in the border, in Chicago, in Baltimore, where you can get killed for a chicken wing. But they're over there, overseas, all over the place to protect the empire, the global business empire, the banks. And the moment we saw the problems in the Red Sea, we did not do anything about it. Until, of course, container shipping rates began to move higher, oil began to move higher, we began talking about the risk of inflation again, then came the military action. And of course, we're going to talk about the CPI today. That's another problem, but you cannot dismiss the geopolitical risk here. Not just the political risk, and this is just one part of that political risk. We still have China, we still have Russia, Ukraine, but also the political risk of the elections. And this is why when everybody talks about, it's hunky-dory, soft landing, the economy is going to be better than ever before, the roaring 20s. What the hell are you people smoking here? Even the top banker in the country, Jamie Dimon, came out warning about the geopolitical risk and how it is interconnected with the inflation risk. So all of these declarations about, inflation has been defeated, and you got Jerome Powell of the Fed, who's an insane person, by the way, thinking that he won. He achieved a soft landing because inflation is at double the Fed's target right now. Not so fast, says Jamie Dimon. We are heading into an inflationary period, not just here, but globally. The inflationary dynamic is too strong. The moment you release the pressure and you declare victory, that inflation will come back with such ferocity, it'll make your head spin. Take a look.
So what about the future, Jamie? What kind of a 24 are you expecting?
Yeah. So, I look at when you say we had a strong year, we acknowledge we're over-earning on NII and credit and stuff like that. And of course, I'm much less worried about the economy and the strong year and what's going to happen next year than the geopolitical stuff. And that stuff is about the freedom of the Western world for the next 100 years. So I'm not comparing that really to the economy this year. And so.
Where does the Fed fit in, Jamie? Right now, it's pretty much priced in. We're going to get 3 rate cuts this year, possibly 2 or 3 rate cuts in 2025. Do you agree with that?
I'm a skeptic. I think that because of fiscal spending and other factors, and let me list them for you for a second. I look at a lot of things and forget just economic models for a second. $2 trillion of fiscal deficit. The Infrastructure and IRA Act, the green economy, the remilitarization of the world, the restructuring of trade are all inflationary. And that looks a little bit more like the 1970s to me. So I think there's a chance that people should be prepared for that inflation comes down, but then bounce around 3, maybe even bounced up a little bit, and those implied curves will change. And then, are people ready for that? I'm not sure, but, I just give that a higher chance than other people give it.
And folks, there is absolutely no possible way that the Federal Reserve will cut rates in March, as the market right now is anticipating. Not just 3 rate cuts, 6 to 7 rate cuts, beginning in less than 2 months. You really think the Fed will cut rates without anything breaking here? They're just going to cut rates out of the generosity of their hearts? That would be a major, major mistake. And indeed, it will get us to an episode like the 1970s. And I think today's CPI report pretty much sealed the deal that there are no rate cuts in March except for the wrong reasons. Headline reads, rising shelter, healthcare costs, left U.S. consumer inflation in December. Gasoline prices rebounded 0.2% after dropping 6% in November. Food prices rose by 0.2% for a second straight month. Grocery food inflation nudged up by 0.1%, matching the prior month gain. Egg prices surged 8.9% as the spread of the avian flu disrupted egg-laying operations at some commercial farms. Here we go. We're back to the same egg problem now. Eggflation. So it's not just shelter, it's airfare tickets, it's used cars. They're all coming back now. We see the monthly change in the CPI moving higher month on month. This was not supposed to happen. You haven't seen a damn thing yet. Wait till you see what the easing in financial conditions has done to the inflationary pressure this month. That's coming, baby. And you look at the month-on-month change, again, we have fuel oil down about 5.5%. But, if you can't afford food, that's moving higher, as I just read. Just let them eat fuel oil. Natural gas down a tick. Motor vehicle maintenance and repair down a tick. Fruits and vegetables down a tick. But then the rest of categories are moving higher. And oh, by the way, if you look at the insurance cost, you want to talk about price gouging, look at the insurance costs. Surging higher. Home insurance, car insurance, healthcare insurance. These rates are skyrocketing. But the hypocrites in Washington, D.C., they will not tackle any of that. Why? Because their top donors are these insurance companies. Not to mention, of course, the utility companies. They're all top donors to the Democrats and Republicans alike. They keep doing price gouging. You didn't see Joe B. barking against them on Twitter. He was barking at the gas stations, the small business owners, gas station owners, and oil companies when that was the problem. Will he now attack the insurance companies? Of course not. But rest assured, folks, if you're suffering from inflation, you can't afford rent, you can't afford groceries, you can't afford paying your utility bills, or you're suffering from high interest rates on your debt. You got the Minister of Propaganda, Janet Yellen, and she says the prices are falling for TVs, cars, and gasoline, and let them eat fuel oil. And the banks are sound and resilient. We have a soft landing coming. What a freak show. You see the annual change in consumer prices, all items, Does this look like bottoming to you? Because it looks to me as it is bottoming here. Inflation is sticky. You release the pressure by cutting rates or giving the impression that you're going to cut rates and inflation will come back and poke your eyes out. Are you listening, Mr. Powell, or not? But of course, the market is in delusion right now. We got a hotter CPI reading. We have all of these problems going on right now. The increase in container shipping rates, you're going to begin to see that in reinflation in goods. And this is why we bombed Yemen right now. It's not about, the safety of American citizens or any of that bullshit. It's about we don't want inflation to go higher in an election season. But good luck, because Jerome Powell, if he does it and do a preemptive rate cut, forget about it. It's over. You'll see oil prices back at above 90 by the summer, and Joey B will be toast. But the market is in delusion, and the market says, you know what? We just digested the CPI, and we think that the odds of a rate cut by the month of March actually went higher. So this is why we got a little bit of a market rebound today. But hold your horses, we're going to talk about this and a lot more, but we go back to Jamie Dimon from the Landromat, JP Morgan. He also warns that it's not just the reinflation risk. Even Jamie Dimon now believes in the duality of the risk. Maybe he's watching the show. And he now says that, look, I don't believe with any of these rate cuts are coming soon or soft landing or Goldilocks bullshit. I think the odds are for a recession. Take a look.
Consumers in good shape. But the extra money that they got during COVID, trillions of dollars, that's kind of running out. And looks to us like it's going to run out sometime. It's been pushed out and out for a whole bunch of different reasons, but it runs out this year. The government has a huge deficit, which will affect the markets. But I'm a little skeptical in this kind of Goldilocks kind of scenario. I still think the chance of it not being a soft landing are higher than other people. That's not terrible. It might be mild recession or heavy recession. Obviously, all of us in business have to know how to deal with, the ups and downs of vicissitudes of the economy. But I do think the cross currents are pretty high. The money running out, rates are high. QT hasn't happened yet. QT may bite. I expect it to, by the way, that you'll see more volatility, particularly unwanted in Treasury markets because of QT.
So are we going to see that recession this year?
Yeah, it's a possibility. I think they did the right thing to raise rates. I think it was a little late, and I think they're doing the right thing just to wait and see what happens. And as you said, it takes a while to see the full effect of that. And there are other financial conditions out there, but all of those factors may very well push us to a recession, and as opposed to a soft landing.
And folks, when we talk about capitulating, look no further than Larry Summers, the latest victim of the soft landing bullshit. We talked about Rubini now capitulating. Dr. Doom, he's capitulating. We talked about Bob Michel capitulating. Next thing you know, Mike Wilson will capitulate. And now Larry Summers, who now capitulated and said that the U.S. soft landing is a very real possibility. Oh, really? How is that a possibility, Dr. Summers, when we have inflation that is sticking? And the moment you release the pressure, it's going to come back and make your head spin. And it means that you have to keep the policy as tight as you can for now, which means that you're not going to have your cake and eat it too. Either you forego the inflation mandate and you cut rates, you rescue the economy from a recession, at least in the meantime, but that means that inflation will come back, or you keep the pressure against inflation and you sacrifice the economy. You can't have both here. And after the CPI, here comes the slew of Fed zombies. From New York, Fed Williams warns no rate cuts until inflation moves down to 2% on sustained basis. Are we at 2% right now, folks? When you got the core CPI almost at 4%, which is double the Fed's target? Of course not. And then we got Chucky from Cleveland. She says that March probably too early for a rate cut. Forget about it. Even the drunk Goolsby, he's not supposed to be in the Fed, by the way. He got his job via corruption. His wife got him the job, so he can get the fuck off the couch, stop drinking beer. He now says that, his rate cut forecast is near the median. We haven't seen enough to do rate cuts by March. Across the Atlantic, Madame Lagarde says the ECB is not going to cut rates until we're sure that inflation is set for 2%. And folks, here's the summary. I said Mr. Powell must realize that to serve one mandate, you have to impair the other. Historically, inflation is not defeated until the unemployment rate rises in the economy. Otherwise, inflation will stick and regain momentum. No cuts in March unless something breaks. And again, Jerome Powell kind of knows that. When we had high unemployment in the economy during the pandemic, he sacrificed the inflation mandate. He said, yeah, sure, let inflation go higher. If that means that we're going to regain jobs and reach full employment again, so be it. So he knew and he knows that he needs to sacrifice one for the other. Well, now we have inflation that is sticking. It went down, but it's going to come back up the moment you release the pressure. So you got to keep that pressure and sacrifice some of the gains in the employment mandate. I'm pretty sure that Jerome Powell knows that. But the problem here is he's a spineless coward and he's a pathetic, weak man. And somebody's going to influence him and say, Mr. Powell, come on. Do you really want to see recession under your wing here? Do you really want to be blamed for a recession? Then do a preemptive rate cut right now. What do you got to lose? Inflation is coming down and the economy is holding. Just do it already. He might be talked into doing a preemptive strike here and cut rates. If he does that, that would be perhaps one of the biggest mistakes in Federal Reserve history. Not only he's going to bring inflation back, he's going to cost Biden the White House, assuming, of course, that Biden will be the guy they're going to run. In other words, if rationale takes place, the Fed will probably not do a March rate cut. They'll keep that pressure as long as they can until something breaks, and then they will do a rate cut. Why is it that pretty much in every rate cutting campaign, in similar circumstances, go look in history, folks, rate cuts, they began in emergency meetings. In other words, the Fed doesn't just cut amicably here. The Fed cuts for the wrong reasons. And keeping that pressure will get us to the wrong reasons. Keeping rates as high as they are right now will damage the economy until we get a recessionary factor, a credit event, and then they're going to begin cutting rates for the wrong reason. By that time, it's too late. We're already in a recession. And this is why billionaire investor Jeffrey Gundlach says that buying the S&P 500 right now seems like a pretty lousy trade because the U.S. recession is looming. And if you thought that was bad, did you forget about the budget deficit here? Did you forget that we have a tsunami of issuance of bonds, which will push rates higher and tighten the policy whether the Fed likes it or not? We've just kicked the can down the road here, and folks declared victory already, that all yields are going down. But have you forgotten that we have a tsunami of issuance coming? Who do you think will buy all of that? If the Fed is not doing quantitative easing, are we going to raise taxes? When is that going to happen? And until that happens, it's the issuance of bonds. It's the only avenue we have because the crooks in D.C., Democrats or Republicans, they're not really going to cut the budget deficit. They're not serious about that. They're serious about taking your money and doing money laundering and handing all of that cash to their donors, defense contractors, insurance companies. So the spending will be on steroids. Democrats or Republicans, doesn't matter. Maybe Republicans a little better, but at the end of the day, here it is. The U.S. budget deficit for December up 52% to $129 billion. If you look at the issuance here, not just the U.S., a lot of other countries, but specifically the U.S., we will continue to issue a significant number of bonds in 24 relative to the GDP. So maybe you can say that we're at peak rates, but you cannot say that rates will continue to go down from this point here. They can rebound because of the CPI, PPI combined with the bond issuance and stick higher for longer, whether the Fed likes it or not. And the damage will take place, folks. Headline reads, the bond market rally is overlooking a soaring $2 trillion debt problem. What are they talking about? Here it is. Over the next several weeks, governments from the US, UK, and the Eurozone will start flooding the market with bonds at a clip rarely seen before, saddled with the kind of bloated deficits that were once unthinkable. So you know when Stephen Van Meter says that unthinkable, he's not joking. Here it is, unthinkable. These countries, along with Japan, will sell a net $2.1 trillion of new bonds to finance their 2024 spending plans, a 7% increase from last year. What is the problem with that? Here it is. With most central banks no longer hoovering up bonds to bolster economic growth, governments must now entice more buy orders out of investors around the world. To do so, the thinking goes they will have to dangle higher yields.
Oh no!
Uh-oh. Just as they did when concerns about ballooning government debt loads was amplified this summer by Fitch Ratings' move to strip the U.S. of its AAA credit rating. The route that resulted sent the rate on the benchmark of the 10-year treasuries above 5% for the first time in 16 years. Ladies and gentlemen, you haven't seen a damn thing yet. You're jerking off too soon here. We'll look at the bond issuance in emerging markets. 2024 will be a record year. There is no escape here. And if you're too arrogant to understand all of what I just said right here, you will be the victim. Keep jerking off. Keep dismissing the risk. Keep being an arrogant prick. But you will be the victim. You'll be begging on your knees, crying for bailouts. But at that time, we're not going to have them. We can't afford them anymore. If you lose your retirement, you lose your savings? Well deserved, because the warnings were already here. Anyhow, let's talk about the market dynamics now, and we go to the morning brief. Here it is. Good morning. Happy CPLI day. The read came a touch hotter than expectations, and we immediately see positive reactions in the US dollar and bond yields, which is negative to equities. When we look at the weekly charts for both Dixie and the 10-year yield, we can see that they're reversing a negative trend by today's action. If it sticks, we close the week above those trend lines, which will indicate that the market expectations of rate cuts by March as unrealistic. We'll look at these charts in a minute here, and we'll do the weekly charts in the weekend video, but with that being said, I think that the market is still in denial, and market participants are still in recency bias, which means they will attempt buying the dip initially. Having overbought 1 hour RSIs in the Dixie and bond yields might aid this initial dip buying move. Then if we see the Dixie and bond yields resuming moving higher, equities will fail to sustain any dip buying move. Now, here's what's really interesting. Just a couple of minutes after this note, in the pre-market session, we saw the Dixie and bond yields reaching overbought conditions in the 1 hour charts. They began to pull down. So here, what you're looking at is the Dixie in orange and the E-mini futures for the S&P 500 in green. So you can see that the market open was 6:30 Pacific time. But before that, you can see a dip in the orange line, the Dixie. And immediately we saw the market being bought by algos. So we actually opened higher. The dip buying happened in the pre-market session. But after that took place, the dollar rebounded and moved higher, so we've seen a gap and crap in equities. Then you can see what happened at around 10 Pacific time. The 30-year auction. It came out lousy, wasn't really that good, but the market said, okay, since we haven't seen a disaster in the auction, we're going to dump the 30-year yield down, and along with it came a pullback in the dollar, as you can see in the orange line going down, and immediately in the green line, the S&P managed to recover. So it is an algorithmic game. Dollar goes higher, equities go down. Bond yields go higher, equities go down, and vice versa. So today we had the CPI, caused a little bit of a shock. Then we have the PPI. Next week we have retail sales. And in between, we have all of this geopolitical risk. We go back to the morning brief because we need confirmations before we decide on anything here. I would look at the E-mini futures for confirmations. If we look at the 1 hour chart, we can see that we have a trend line of support that is still holding. If this line is lost and confirmed by the loss of support line at around 4,800, then we can only confirm a reversal if the E-mini future loses the support of 4,772. Here's the chart that I gave you in the morning, an hourly chart for the E-mini futures. So if we lose 4,808.25 or this trend line in yellow, that would be a confirmation for a pullback. But we have no reversal confirmation until we lose 4,772. Here's the update. We went down pretty much to the penny to the reversal confirmation line, never made it below. So we got a confirmation for a pullback. We played the pullback, but then no confirmation for a reversal so far. If we lose it tomorrow, then we have a confirmation. Back to the morning brief. As far as the Bitcoin ETF approval, I would look at Coinbase that is. If the chart reaches its 20 MA and gets rejected, I would take a swipe against it, especially if I see Bitcoin reversing its early gains. Here's the chart that I gave you, daily chart for Coinbase. Expectations were for a retest of the 20 days moving average, then a failure, a reversal. We have a trade there. Here's the update. We got pretty much to the penny, to the 20 days moving average, but we flushed down big time. Now we have the bear flag played out. We got a retest and a rejection of the 20 days moving average. We have a bearish engulfing candle. Can we see more downside in Coinbase? Yes, but we do have support of the lower Bollinger Bands at around 136.46. So it's going to take a huge volume to crack below this support of the lower Bollinger Bands. If that happens, then we'll probably have expansion of the Bollinger Bands to the downside, and this will open the path for more losses in the stock here. And yes, of course, the custody of the new Bitcoin ETFs are all with Coinbase for the most part, so it benefits from all of them, but these new ETFs will also eat away some of Coinbase's business, meaning that a lot of inflows will come into these new ETFs. Well, the inflows has to come out of something. So we see outflows out of these platforms such as Coinbase, the miners today, even names like MicroTrageedy. We've seen outflows out of these names and inflows into the new ETFs. In any case, let's move on and expand the conversation here, folks. And we begin with the closing of the indices today, and here we go. The diamonds in the green, be it a touch above the neutral line here, up by 15.29 points or a gain of 0.04%. The Nasdaq In the green, be it flattish, up by 0.54 points or a gain of pretty much nothing. The spider down, be it flattish, by 3.21 points or a loss of 0.07%. The loser of the day, of course, the yield-sensitive Russell 2000, down by 1.53 points or a loss of 0.78%. We look at these sectors, it was all big caps today, so technology came at top. Energy caught a rebound because of the geopolitical problems. To begin with, we got the news about Iran seizing the tanker, so there were already problems brewing before the attack against the Houthis. Meanwhile, the laggards are the yield-sensitive utilities, real estate, and financials. If the PPI comes out hotter, we're probably going to have a problem with these names again. The breadth was not good, despite the fact that the indices were flattish, thank you to the big caps, but the NYSE was only 36% advancing versus 62% declining. The NASDAQ, 31% advancing versus 67% declining. We've seen an interesting tape today. So any yield-sensitive or dollar-sensitive name, they were actually down. But the big caps gathered some steam here. Meta was up big, Amazon was up big, and that's pretty much the reason why we've seen indices closing flattish today. We gotta look at the charts of the big caps. A lot of them appear to be due for a pullback, so we'll talk about that in a minute here. But before we do that, what about commodities? Energy commodities up due to the geopolitical risk and the news that we got about Iran. So we see the WTI and Brent up about 2% apiece. Brent was up a little more by about 2.25%. The gasoline RBOB up about 3.5%. The gains in the gasoline RBOB exceeding the gains in crude oil. That's going to be good for the refiners. So we see names like Valero and MPC, Marathon Petroleum, all outperforming the pure crude oil plays. Then we have heating oil, diesel up by about 3.5%, and natural gas, a decent session again, above 3, up by about 2.5%. Now natural gas has a lot of momentum because of the weather, not just across the Atlantic where we see storms and below average temperatures, but here we have a massive storm beginning in the northeast and now moving all the way down to the south, and the temperatures will be freezing. So if you happen to live in Texas or anywhere in the south, you better have a good coat on you. But the storm going down south where the Henry Hub is in Louisiana, that's going to impact the prices of the Henry Hub and move it higher. So we see a lot of tailwinds here behind natural gas futures. We might even see some snow here in the city of Las Vegas. So temperatures are going down, more consumption of natural gas, and it keeps going higher. The dips are being bought in natural gas. If we look at other commodities, it was a decent day for softs up across the board. Gains led by OJ. OJ's rebounding again, up about 3%. Sugar up about 2%. Cotton, cocoa up about 1.5% apiece. Coffee up a little over 1%. And lumber with fractional gains. Metals were flattish. The dollar was all over the place, so no clear signal here. Gold and copper were up. Palladium was flattish, but silver and platinum futures were down. Meats, positive, beet modest, under 1%. Across the board, grains, again, the dollar did not go one way or the other. So we see wheat, which was the winner, now down about 1%. Oats was winning for a few sessions here, now pulling back about 1%. Same goes for corn and soybean meal. But we do have a rebound of soybean oil futures, up about 1%. PPI will have an impact here. If the dollar goes down tomorrow, we will probably see these futures going back up higher again. If we see the dollar going back up because the PPI is coming out hotter, we're probably going to see a pullback at least in metals. Moving on to the big casino, the options market, what do we see here? The volume is hotter for Tesla. It moved significantly higher. Now we're over 2 million contracts. The majority of them are calls buying the dip. We'll discuss the case for buying the dip and for shorting the stock at this point in the chart analysis. We've seen the volume exploding for Marathon Digital Holdings. Folks are now buying the dip even though the stock is down double digits today. So we might have seen a lot of bag holders here buying initially and then the stock went down. You got to be careful with these things. The stock been rallying higher into the news. So we have the phenomenon of sell the news. Likewise, Nvidia remains hot. The IV rank is still low. So believe it or not, Nvidia's options are still cheap. So folks are using it to move the stock higher. We see the bias here in buying calls versus puts. But again, if you look at the chart, we'll do that in a minute here. Maybe it got a little too excessive and we need a pullback, but all in all, the chart remains positive. We look at the unusual activities that took place in the options market today. We begin with the ticker FXI, the Chinese ETF for technology. We have seen massive call options buying in this ticker here on the rumors that the Chinese government will probably launch the bazooka and do stimulus. Now, I'm on the camp who says that Xi Jinping is a firm believer in communist China and all of that. He views the U.S. model as corrupt. Last thing he wants to do is stimulus. But he's only going to do it if the economy gets really, really bad. Maybe we're at that point right now. I am skeptical, but we have a trader here who bought the 24.5 calls for the expiration date March 15th. The expectations, the name will move higher and gain more than 7% by then. Paid about 50 cents a piece, tenor. This trade, all in all, spending about $500,000. Then we have the ticker CCJ Cameco. We talked about this name. I own it. It's been moving higher. Nice rebound, but somebody's betting against my boy here. Betting for a pullback. And they bought the 43 puts for the expiration date February 9th. The expectations, Cameco will go down and lose more than 8% of its value by then. Paid about 75 cents a piece, tenor. This trade, all in all, spending about $750,000. Then we have the ticker CYTK in healthcare, and the stock was down big today. And the reason is Novartis was rumored to buy the company. Then they said, okay, we're not going to buy it, and the stock dropped down big. Somebody sees the drop as excessive, and they're betting for a rebound. They bought the 105 calls for the expiration date March 15th, with expectations that the name is going to rebound and gain more than 23.5% by then. Paid about $4.25 a piece, tenor. This trade, all in all, spending about $3 million. And then we have airlines earnings coming out as soon as tomorrow from Delta Airlines. Somebody sees bad news for LUV Southwest. They're taking the other side here. They're buying the 27.5 puts. Expiration date February 16th. The expectations, the name will go down and lose more than 8% of its value by then. Paid about 50 cents a piece, tenor. This trade, all in all, spending about $300,000. Moving on to the heat map, what do we see here? The opposite of the theme from last week. So last week was all about value. It was all about dividend-paying names. So we saw Verizon, AT&T, utilities, real estate, financials, healthcare, all moving higher. In today's session, we see the Verizon, AT&T down big, utilities down big. Healthcare, we see pullbacks in certain names. Real estate down, financials down. We see the rotation back into the mega cap stacks. Microsoft, Nvidia, Amazon. Not so much for Apple, Google, and Meta today. Might have made a mistake in the initial reading of the sector performances. I said that Meta pushed comm services higher, but it was actually Netflix that moved higher by about 3% today. But the chips were doing good. Nvidia, AVGO, Broadcom. The cybersecurity names been on fire. Palo Alto, CrowdStrike been moving higher. Now we see some money coming into the software names. CRM, ServiceNow, Salesforce, all higher. Now whether these flows are sustainable or not, we talked about certain charts like Nvidia and Microsoft looking pretty good. Apple, Meta, Google, not my favorite. Amazon, we'll look at that in a minute here. But boy, Tesla, what's up with that name? I disagree that Tesla is part of the Mag 7. It's not. If you want to include a Mag 7, go with Broadcom or maybe AMD. Maybe Salesforce, that's going to be the guy. But it's certainly not the souffle. And the reason is we have bad news. And when it rains, it pours in the souffle. The bad news began with, Tesla Berlin factory will stop doing output for about 2 weeks due to the Red Sea disruptions. So maybe this is why we're bombing Yemen right now. In either case, this is not going to be good for Tesla because now the implications are we're going to have more escalation in the Red Sea. And the stoppage of output might extend here. On top of that, we got the bad news that the souffle is now raising pay for U.S. factory workers. They saw what happened with the UAW and GM and Ford and Stellantis. They want the same. That's going to add more pressure on the souffle. The margins were already bad to begin with. Now they have to pay more in wages. Forget about it. On top of that, we got news from Hertz, the scam company. Remember back a couple of years ago when they said, we're going to electrify our fleet and buy all of these souffles. And the stock shot up higher. Then the executives dumped stock and said goodbye. Well, that was a bad decision. Not the executive dumping. That was actually a good decision. But for the company to buy all of these souffles, that was misguided to say the least. Because when you go rent a car, they give you a souffle. The initial reaction is no thanks. I don't know how to operate this thing. I don't know where I'm going to charge it. I don't know nothing about it. Just give me a regular car here. Same thing for me when I order an Uber and the driver has a souffle, cancel the ride right away. To begin with, you don't even know how to open the door. So now we see that Hertz is deciding to say, okay, no more EVs. Dump all of the souffles that we bought. 20,000 souffles at pennies on the dollar. Really cheap. What is that going to do? Increase the supply of souffles in the used cars market? Reduce the prices down? Well, Tesla now has to reduce their prices too because they have competitors in the used market. More and more pressure on margins here in this company. It doesn't look good here, folks. When we look at the heat map for the ETFs, what do we see here? Despite the fact that the TLT and the TMF were higher, meaning bond yields actually went down. we see that yield-sensitive ETFs, beginning with small caps, IWM, that was down, the laggard for the day. But you look at utilities, you look at real estate, utilities being XLU, real estate IYR, XRT retail, biotech XBI, KRE regional banks. All of these are yield-sensitive, and they were down. The exception, of course, the XHB and the ITB, home builders, and this is because the strength of Lennar. But what is the message here from the divergence that the TLT is up, but we see yield-sensitive ETFs down? Maybe the ETFs are saying, look, whatever happened in the bond market today is an exception, but yields are going higher, so we're going down. Then we'll look at the dollar-sensitive ones. If we look at the XME metals, flattish. If we look at chips, slightly positive. The SMH, energy, flattish. And the reason is the dollar was flattish, so there's no guideline here. You look at the gold miners, GDX was down, SLV down. But maybe we're getting closer to a rebound here. More on that in a minute in the charts analysis. But before we do that, you look at dollar sensitive. In international markets, we see the FX side, Chinese equities moving higher. Maybe this is because of the rumors of Chinese government doing stimulus. And the last observation here is look at the contrast between energy ETFs, be it the XLE, XOP, or even the OIH. They're all flattish for the day. But you see the USO, which is the oil fund, which tracks the commodity. That's up a little over 1.5%. In other words, right now, if you're betting on the geopolitics, you want to stick with the commodity, not with energy stocks. So you want to stick with the USO, not ExxonMobil, at least for now. You can also hedge against the geopolitics by having the defense contractors, be it LMT, NOC, or even Raytheon. If you want to buy an ETF, go with the, not the ITA, because the ITA has a huge weighting of Boeing. So you want to go with the PPA. The PPA, the weighting is more equal. So you're not going to be relying on Boeing, which in my opinion is just a partial defense contractor. It has a lot of problems with the flying coffin. So you want to go PPA over ITA. Let's do the charts here and then wrap it up. We begin with SPY, the S&P 500, an hourly chart. What do we see here? A roller coaster ride. So we gapped higher, then flushed down, gap and crap. Did a revisit to 473, which was an important number from an options perspective. It was the point where we can get a gamma squeeze, inverse gamma squeeze in the puts, had the market maker lost that point. So I'm not surprised to see a rebound operation. But if the rebound was due to the market maker not being ready to go below 473 for today, then that opens the path for this as being an inverse ABC pattern, and now the market maker is prepared for losing 473 tomorrow. That's the bearish outlook, of course. The bullish outlook, we'll look at the daily chart here for the SPY. Now, before the week even began, we said that there's an easier path for us traders, and that would be just drop the SPY all the way down to the target of the lower Bollinger Bands, get it really oversold, then we close the shorts, we go on the long side, and we get a rebound after the CPI. And then there was a harder path, which is we get a rebound Monday, Tuesday, Wednesday into the CPI, and then we'll be at the mercy of the CPI. And this is exactly what we got. They made it harder for us, not the easy way. So we got a rebound Monday, big one, then a follow-up Tuesday, Wednesday. We're above the 20 days moving average now. CPI day got us in a retest of the 20 days moving average, and it was a success, at least for now. So the assumption right now, looking at the daily chart, is we have to finish the move higher. We have the upper Bollinger Bands. We're not going to say that the SPY has more downside to come until we lose the 20 days moving average again. That would be a confirmation. The 20 is a no-go, but we have further downside to come. And guess where the 20 is sitting at? 473, almost. That number is really important, 473. We lose that, we close below, forget about it. Even in futures daily chart, what do we see here? Above the 20 days moving average, but again, it's not decisively so. We could lose it any moment here. If we remove the Bollinger Bands, the moving averages, and we stick to the drawings that we have, we talked about 4,700 as being stiff support. We got a rebound off it. Now the number becomes 4,772. If we lose that, we can say, okay, we have a reversal confirmation. And the ultimate confirmation that we're done, this is a top and down we go from here, is losing 4,700 in the E-mini futures. So we have a bit of cushion here if you're holding longs and you happen to be in the bullish side. But you got to be careful. If you begin to lose 4,700, you need a hedging plan, a really strong one here. About the Qs, an hourly chart, what do we see here? Again, we talked about 404.5. The importance of that number in the live stream and in the shows before. This is why I have it marked here. So we got a gap and crap, but we never went below 404.5. Got a rebound off that. Now it could be that we had a pre-positioning and the CPI will be soft and higher we go. So when that didn't happen, a lot of market makers decided to play a game of, okay, let's get out of our positioning here by manipulating the market and creating a rebound midday. Mission accomplished. Now what if they're ready for a drop? Finally, if the PPI comes out hotter than expectations, then yields in the dollar pop higher. The Qs could do an inverse ABC, but we got no confirmation here that we lost momentum until we close below 404.5. Then we can talk about, okay, there's a path for more downside, maybe closing the gap for Monday. Otherwise, the assumption should be once we pass above 410.47 again, and we close above that from an hourly chart perspective at least, then we're going back to the highs. You look at the daily chart for the Qs, again, a retest of the 20. It was a success, but we have no close above the gap. What is the message here? If you're bullish, you'd say, okay, we retested the 20 and it's okay for support. We've done that twice and it's okay. If you're bearish, you'd say, yeah, but you didn't close above the gap, meaning you go down tomorrow, you lose the 20, and then we have more downside to come. Looking at the chart right now, from a technical standpoint alone, when you have a retest of the 20 and you close almost at the highs, then you gotta assume that the next move will be to the upside and finish the move all the way to the upper Bollinger Bands at around 414.65. Now, is it in the bag? No, we depend on the PPI, and the PPI, if it comes out hot, then the dollar and yields will spike. We're probably going to head down in a retest of the 20. And if we begin to head that way, you're going to know for sure that the 20 is not going to hold this time around. We're going to breach the 20, close below, and have the path open for more downside next week. NASDAQ futures, what do we see here above the 20? We can lose at any moment right now. And most importantly, if we lose 16,767.5, we got a problem here. We're probably going to head down to the lower Bollinger Bands. You look at the Vortex indicator, for example. It's a battlefield. You can make a bullish argument, you can make a bearish argument, and you have a lot of ground to support your argument here. For example, if I'm bullish, I would say, look, we're above the 20. Let's finish the move and make a higher high in the pattern. If I'm bearish, I would say, watch out here. You haven't made a high yet, and we could be looking at an inverse ABC pattern. Once we lose the 20, we lose 16,767.5, then we have more downside to come. And this is exactly what the Vortex indicator is showing right now. It's a battlefield. We have no decision yet. If this is too hard for you as a trader, you might want to step back, preserve your ammo when you see an easier trade. Example, if we pass above the highs, 17,165.25, then you know we have more upside for sure. You can trade it that way then. If we lose 16,767.5, then you know that we have more downside for sure, and you can trade then. But you don't have to trade when we have a battlefield between the bulls and the bears. The IWM, daily chart, what do we see here? Unlike the SPY, and the Qs, this guy's not moving higher. It is the most yield sensitive. It has more zombie companies than any other ETF. So we have a bear flag. It appears that it is playing out right now, but we also have the support of the lower Bollinger Bands at around 190.5. If there is a reading of the PPI tomorrow that is way hotter, we see yields moving higher in a big way, above the 200 days moving average, which we're going to talk about in a minute here, then assume that the IWM with higher volume will breach the lower Bollinger Bands and expand them to the downside, reaching the consolidation pattern that I'm highlighting here, which will be really strong support in or around, let's say, 185. Dixie, what do we see right now? Today, got a pop from the CPI, then came down. We're still above the 20. We're still seeing an inverse head and shoulder. The momentum indicators are all positive, but weakening. If we lose the 20 because of the PPI, then assume that the dollar will go down. It means that we're going to see a rebound in equities. It doesn't matter what the reading is or what happens in the geopolitics, because the dollar going down, equities will go higher. That's how the algos react. Unless, of course, we have the human being interfering and placing a large sell order for whatever reason. So the dollar is the most important chart to watch tomorrow. And if it goes down, then you got the old man gold. It went down to the lower Bollinger Bands, caught support. Now it's waiting from the signal from the dollar. Are you finished? Are you going to go down? Are you going to lose your 20 days moving average? If you do, then I'm going to go above my own 20 moving average. I continue to advance higher, maybe to the upper Bollinger Bands at around 2080. Now if the dollar pops, we're going to have a problem with gold here. We're probably going to breach the lower Bollinger Bands and expand them to the downside. But one step at a time here, folks. If the dollar goes down, then you look at the GDX gold miners at the lower Bollinger Bands, getting a little oversold. We have probably a falling wedge pattern. If the dollar goes down, we could see a pop in the GDX here. So if we see the dollar down after the PPI, you probably want to go with the GDX, not the GLD, because the GDX was damaged more. So it's going to rebound more. And the same goes for the SLV. We got to the lower Bollinger Bands, getting a little oversold. We have a falling wedge pattern. The chart is just waiting from the dollar to say, okay, I give up on my 20 days moving average. And the SLV will pop higher, maybe reach all the way to the 20 days moving average at around 21.66. Otherwise, if the dollar pops, then we have more downside to come in the SLV. We're going to expand the lower Bollinger Bands, but we do have support in or around 20.27. UK oil, Brent oil, what do we see here? Highly volatile. Now with the news, we're above the 20 days moving average. We're probably going to expand the Bollinger Bands to the upside, so we have more upside coming for oil here. But boy, look at the Vortex indicator here. It gave us a bullish sign in December, then went down and gave us a bearish sign just a couple of days ago. As you see the red line, the bearish line moving above the blue, which is the bullish line. Now we see the blue line moving higher again above the red. So the bullish line is gaining momentum. It is really, really volatile. But for now, it appears that the bullish momentum is going to win. We will see a pop in crude oil. Question is, if you're not really liking the volatility in crude, but you still want to hedge against the geopolitics, maybe a sustainable bet would be defense contractors, not the volatility in oil, because oil has headwinds too, and that comes from supply. So you're going to be back and forth when the geopolitics cool down. Now all eyes go to the supply, and that's problematic to crude oil. Crude oil, if you happen to be a bull in crude oil, you don't want to talk about the supply at all. You want to talk about the geopolitics all the time. Until, of course, the supply-demand dynamic is improved. Look at the 10-year yield daily chart. What do we see here? We can blame it on the auction. We can blame it on the technicals, which is, again, the 10-year yield went higher all the way to the top of the Bollinger Bands and the 200 daily moving average and caught a rejection. But we do have support at the 20 moving average. We're not going to say that bond yields are done here and they're going to go down again until we lose the 20 MA. If that is the case, then we're going to go along the IWM and the yield-sensitive names again. But we're not there yet. We could see just an initial reaction of the 200 MA. But if the PPI gives the 10-year yield the fuel needed to make it above the 200 MA, it's going to be a breakout. In that scenario, the market is going to flush down, led by the IWM and the yield-sensitive names. So if we look at the XHB here, what do we see? We closed the gap above. We're flirting with the 20 days moving average right now, but we have no confirmation to short this guy until we lose 91.45. At least the 30-year bond yield has to close above its 200 days moving average, and the look is similar to the 10-year, so I'm not going to show you here. The IYR real estate ETF also yield sensitive, but it is looking a lot better from a bearish lens than the XHB. It is below the 20 days moving average. It is below the 90.50 line that we identified before as a critical line, but it caught support from the lower Bollinger Bands at around 89. All momentum indicators, be it the RSI, MACD, or even the Vortex, are showing bearish momentum. We zoom in to the hourly chart. What do we see here? We talked about which one is it going to be. Are we going to revisit the yellow line below or above in this channel, in this consolidation? Well, now, at least looking at the chart right now, the hourly chart, it appears that maybe the lower end of the channel will be met first, and then if it doesn't hold, then we break below and say goodbye to the upper end of the channel. If it holds, maybe we're going to rebound later on. But looking at it right now, we can argue that we have a head and shoulder formation, and down we go in a revisit of this line of support here, which will be in or around 88.5. Depending on when it's going to happen. If we look at the KRE regional banks, yield sensitive, we lost the 20 days moving average, lost 51.38, all good. Problem is we have support at the lower Bollinger Bands and we caught it today. Now it's going to require an event such as bank earnings tomorrow blowing up or the PPI coming out really hot, spiking yields higher. If that happens, then the KRE will flush down and expand the Bollinger Bands to the downside. This is why we had a bearish trade on the KRE. And folks who asked me today, I said, look, since we're at the lower Bollinger Bands, if you want to book profits, do it, because you're going to have a catalyst tomorrow. And if banks move higher and you have the puts for Jan 19th expiration, you're going to be toast. There's not enough time for repair here. So if you made profits, you want to book them, and maybe roll to a longer expiration date if you still see downside in the KRE. How about the VIX 4 hours chart? There is no fear in the market here. CPI, CPI, PPI, doesn't matter. Geopolitics doesn't matter. The VIX closed the gap, and now we were anticipating maybe a higher low. If that was the case, then we're going to move higher. But now we're back at the previous low. Double bottom maybe? Sure. But the case weakened a lot. Is there still a bullish case for the VIX? Bearish case for the market? The answer is yes. You look at the daily chart. Maybe we have a falling wedge here. We're going to break above. Gave it a shot today, but didn't happen. But then again, you look at the momentum indicators, MACD, Vortex, RSI, they're all trending down. They're all suggesting that the VIX will go down from this point on. But again, I think it's up to the PPI tomorrow and the slew of data we're about to get. If there's a pop in yields or the dollar, we could see this falling wedge playing out and the VIX will be out of the woods. But looking at it right now, the bearish argument for the VIX, the bullish for the market, is the predominant one. Big Cajon Apple daily chart, what do we see here? Got a rebound off the 200 days moving average, off a falling wedge. Got it. We were oversold. Now we're not oversold. So can we go back and short Apple at this point? I would say you got to be really, really careful. I wouldn't do that until we lose at least 183. Then my target would be at around the 200 days moving average at 180.5. The big short will not happen until we lose the 200 days moving average. Otherwise, the assumption is Apple will advance higher in an attempt to at least reach the 20 days moving average. But before that, we have 188.57, and after those two, 188.57 and the 20 days moving average, which is a touch above 188.57. We have closing the gap. Perhaps a better looking chart than Apple is Microsoft. We talked about this consolidation here and that the energy will be released to the upside. Indeed it did. Today we stalled a little bit here. Why did we stall? Even though the momentum is beautiful. MACD, RSI, Vortex, all positive. We stalled because if we plug in the Bollinger Bands, it got a little too excessive in a short amount of time. We're moving out of this tight consolidation range. The chart needs a little bit of time to adjust. Wouldn't be surprised to see a pullback. But any pullback right now, so long as we maintain the 20 days moving average, is a buying opportunity for Microsoft. Now, if we contrast Microsoft with Amazon, we can see a pattern with the big caps, with the exception of Apple. Most of them right now getting a little too excessive. At the top of the Bollinger Bands, above the Bollinger Bands, so we're facing a lot of resistance here. I would not be surprised to see a pullback in Amazon, retesting the 20. And if that holds, then we're okay. You can buy Amazon, you can buy the dip at that point and move higher. But if we lose the 20, then we got a problem. We're probably going to go down to the lower Bollinger Bands again. And the same can be said about Meta. I mean, it's moving higher. Lots of questions today about do we short Meta? And I say I'm not seeing any reversal sign here. Excessive, sure. RSI overbought, sure. At the top of the Bollinger Bands, sure. You might get a pullback out of it if you're speculating here, but there is no confirmation for a reversal yet. Furthermore, you clean up the chart. We're still in a pattern of higher highs and higher lows. So if we get a pullback right now, the assumption is we're probably going to form a higher low, and the chart doesn't become bearish until that's broken, and that's probably not going to happen until the earnings report comes out in around February. Tesla souffle, here it is. What do we see? We lost 230.61. That's bad. What else is bad? We lost the 200 days moving average in white. That's definitely bad. Then we have the momentum indicators on the daily chart all moving down. The good news, if you happen to be bullish souffle, you have some support here at around 225.37. But you lose that, then you got no other argument here, because that line will also be the lower Bollinger Bands. So if you lose that, we have to look at the weekly chart. And the weekly chart says if you lose the lower Bollinger Bands and you're not going to capture the 200 days moving average, then the chart will probably, in the weekly chart, will go down and revisit the lower Bollinger Bands, and that will be a downside from this point on of about 10%. If we look at NVIDIA daily chart, we talked about the inverse in the shoulder and that the chart is looking good. And indeed, it popped higher. Major breakout here, higher volume, expanding the Bollinger Bands higher. It's a bullish look. But did it get a little too excessive here? And the volume is receding. We're seeing the selling volume improving now, moving higher. The answer is yes. Are we due for a pullback, just like Microsoft, for example, like Amazon? I think all of them are right now pointing out for a pullback, but perhaps NVIDIA is the strongest. With that being said, the assumption is it's a pullback. Then we're going to see more dip buying. The Bollinger Bands will expand higher. We will see dip buying, and NVIDIA will not be damaged until the bullish thesis is negated, and that is the loss of the pricing power. We're not there yet. How about MRK Merck daily chart? What do we see here? Still holding, but I do like the trade that we have for a pullback in Merck. The JP Morgan Healthcare Conference is pretty much over, so whatever pump we got in MRK, it should be done now, as close as we can. Of course, there are no guarantees. We could see a defensive theme tomorrow and Merck pops higher all the way to the upper Bollinger Bands. But the risk versus reward says right now, the odds are closer for a pullback. So we want to stick with the trade here. The put spread, 118.14, costs less than $1, and you can flip it for a quick buck here and double the trade. The moment we go down to, let's say, 116, 115.5, the trade will be achieved. Then we have tulips, Bitcoin. What do we see here? Surprisingly, not to me at least, but to a lot of folks, after the SEC approval, folks are saying, wait a minute here, why are we not seeing a pump? Well, the pump already took place since November. Folks been buying Bitcoin in anticipation of the approval by the SEC of these ETFs. Okay, we got it. Now what? Sell the news? Not in Bitcoin yet. It is just holding here because the Bollinger Bands are really tight, so it couldn't really get above it. It is expanding the bands higher. So for now, it leans bullish. If it loses the 20, then we can say, okay, we have sell the news, and down we go from here. But sell the news, folks, took place not just in Coinbase, but also in the miners. So you look at Mara, Marathon Digital Holdings. Big bearish engulfing candle today. Big reversal, said the news. We lost the 20 days moving average. Are we in for an inverse ABC here? If that is the case, this guy can lose a lot. We can go down big. So anybody who's holding this chart right here, you better buy it tomorrow and close above that 20 days moving average. Otherwise, we have more downside to come here. Let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? Boy, do we have a lot. And it begins with the PPI. Of course, it was negative last time around, so any rebound will indicate that inflation will move higher, even in the CPI in the next reading. Of course, the geopolitics and what's going on with Yemen right now, that will be front and center. And then we have the Dimon from Minneapolis, Fed President Neil Kashkari. Will he flip? I would say that he's going to flip and talk about rate cuts. But who knows? If the PPI comes out hot, he's probably going to talk the market down. Anyhow, folks, interesting day. Been a long day. We've done the morning brief, the chat in Discord, the live stream for about an hour and a half today, and then we're doing the show right now, so I gotta rest here. But rest assured, we'll be back in business again during the weekend. But until then, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Such a waste of talent. He chose money over power.